It's been what can only be described as a bit of a difficult year for many investors in 2022. What's happening in 2023? What should we look forward to or be aware of as investors and traders in this febrile market? Who knows where it's going to go next? Well, we're interviewing a lot of people here as we look into next year, and I'm now able to catch up with an FT columnist who's a columnist for the Adventurous Investor, and he produces a newsletter about the Adventurous Investor for the FT. It's David Stevenson. Is also a director of Doceo.
Hello,
David, it's great to be able to catch up with you again. Thanks indeed for your time. What should we take away from 2022 as a lesson to be learned as we look into next year?
Well, lessons to be learned, which is central bankers aren't always right, and particularly central bankers in Europe and particularly London aren't always right. So they've been behind the curve, and that's caused lots of problems for the UK in terms of interest rate rises. And I suppose the other thing we've learned is that the markets have become far too obsessed about kind of big picture, global macro stuff. And they failed to sort of see, what's the elephant in the room, to mix metaphors, which is that we are heading into a slowdown in America, maybe a recession in America, certainly a recession in the UK and Europe. And that will have a knock-on effect on corporate earnings. And corporate earnings it's the flow of cash flows, the flow of corporate earnings that effectively underpins valuations for stock markets. Stock markets are in markets that invest in stocks, and stocks are primarily denominated and valued by their flow of corporate earnings, not exclusively. And people have got too obsessed by all the big picture stuff. Will Jerome Powell do this? Will he not do that? Will he pivot? Will he not pivot? And we've lost sight of the fact that this is a rapidly changing corporate earnings picture. We've actually had a good set of numbers in quarter three, slightly less impressive so far in quarter four. But going into 23, I mean, and sure as night follows day, if there is a slowdown and possibly a recession, that has to impact corporate earnings. And the market doesn't seem to have quite cottoned on to that yet.
It's interesting, isn't it, when looking at these markets and analysing which markets are moving where. We know that tech stocks have been underperforming. We know that some of the more traditional stocks have been some of the better performers. And in fact, if you look at some of the indices, it's amazing actually to see that the FTSE 100 has actually held up quite well during this turmoil. We've seen big emptying out of the NASDAQ, for example. And some of the big tech stocks are down really heavily into the back end of 2022. And as I say, the London FTSE is actually not too far away from where it was as we went into 2022 from 21. But you then correctly talk about this idea about a recession. And we know from the OBR data that apparently we are in the UK already in recession. So it seems like we've got into that earlier than most. Is the market beginning to price in an early exit, do you think, from recession here in the UK? Markets like to look at the future. What are we pricing in at the moment? Or do you think the markets are mispricing what you say is the risk?
No. There's a fundamental error in the analysis, which is the FTSE 100 is in the UK economy. So the FTSE 100 is effectively a marker for the commodity sector or the resources sector and a few other sectors like finance. So it simply reflected a kind of move in an inflationary environment towards companies that have got pricing power or have actually can set prices if they're in the commodities market. And therefore, the connection that's made from the FTSE 100 through to the UK economy doesn't work. The FTSE 250, which is a much better surrogate, the UK domestic economy, has had a terrible year. And it's tracked much closer the performance of the S&P 500 and to a lesser degree the NASDAQ. So there's been a kind of a retreat to big defensive names with a resources focus. So, BP's, Shells of the world and all that kind of stuff, the big mining companies. And they've done pretty well. And in fact, if we look at America, this is very interesting. If you look at the FactSet numbers, which is the numbers that give you a lot of detail about corporate earnings coming out on a quarterly basis in America, if you take out the energy sector from the S&P 500, which has had a spectacular year, and I think we might have a spectacular year next year as well. Maybe we'll come on to that. Actually, US corporate earnings in the S&P 500 in the last quarter were already down. So you could see the telltale signs of a slowdown already in the American figures. It's the US energy sector that's kept corporate earnings sort of powering ahead in America. But take them out, it's a grimmer picture already in America. And that doesn't include the tech stocks. Because actually some of the tech names have done reasonably all right. Their numbers aren't great. Some have seen decline in advertising revenue, but actually, they've not done that badly. But there've been some pretty kind of savage numbers coming out already on the EPS numbers on the quarter 3 and quarter 4, and we'd like to see more of them in quarter 1, quarter 2. The consensus at the moment is quarter 1, 23, according to FactSet and Ed Yardini, who does a lot of work in this area. We're likely to see a kind of 5% decline quarter by quarter sequentially. I have to say I find that number laughable. I think you'd like to see much bigger falls than that.
Yeah, I want to pick up on that point you mentioned about energy in just a moment again, and with regard, especially as you say, to the FTSE 100. But let's pick up this point about central banks and what they're doing. This upward trajectory, quite steep trajectory in some cases on interest rates, obviously going to do some damage to what little growth there was around anyway. And as we are already in recession here in the UK, what does the central bank do in 2023? Because of the experiences since the financial crisis, the central banks have come to the aid of the markets. When they suspect there's a bit of weakness, when there's a frailty around, they start pumping money in. Why won't they do it this time around to come to the aid of the markets and give us this continued support by going back into QE?
Well, I think, okay, so let me unpack that. I think there's a series of answers to that question. I think that we could see QE come back again if we have a particularly deep recession. And I think the most contrarian bet for 23, which I don't think is likely, but it's not impossible, is that you might have deflation come back in, because the recession will be so bad, the hit will be so hard economically that in fact inflation will vanish in the system and you had deflation. I don't think that's likely, but I don't think it's an impossibility. And if it were to happen, QE could come back in again. If we trip from a mild slowdown into a mild recession into a proper depression, we could see QE come back in again. And we've already seen how, at the drop of a hat, the Bank of England restarted its gilt buying program to cover up for all the disastrous series of mistakes earlier on in the year. But we need a little bit more detail than that as well, because what goes on in the UK is not what goes on in the US. I actually now believe that Jerome Powell, the chair of the Fed, actually has the reverse of the Bernanke put in operation, which is whenever he sees stock markets power ahead, he thinks, actually, guys, that's dangerous. I'm going to put my foot down on the brake and I'm going to put interest rates up because I don't want too much exuberance, irrational and consumer exuberance. So therefore, buoyant stock markets tell me, got to keep my foot down on the pedal in terms of getting those interest rates up. So I think the Fed maybe have switched positions for the time being. The UK is a very different beast again. And the UK has got a problem on its hands, which is the central bank in the UK was late to the interest rate rising party and is trying to make up for lost time. But I would say that Jerome Powell has staked his reputation on being an inflation hawk and wants to get inflation back down quite drastically, certainly core inflation below 5%. I sense that the Bank of England would probably be a bit happier if inflation was a bit higher. I think they're not as hawkish. And let's be honest, the UK traditionally structurally has had higher inflation rates than many other developed world economies. So I think that the Bank of England is less of an inflation hawk, whereas the Fed is much more of an inflation hawk. So they have different imperatives to looking at interest rate rises. So I don't think you could read across necessarily what goes on in the US to the UK and vice versa.
Okay, let's steer the conversation back now to what you were also saying about this point about energy. When we're talking presumably about fossil fuels generally and the supply coming through from OPEC, OPEC Plus and the non-OPEC nations and the amount of oil there is in the market at the moment. We are seeing a drop in the price of oil. We've got Brent hovering around that $80 a barrel level at the moment. It's been a lot higher, of course, recently, but in the last few years, of course, it's also been on the downside. How is this all going to play out then next year? Because my understanding is if we see oil languish at these sort of levels, we could well end up getting OPEC come back into the market and say, well, look, we'll take another 2 million barrels off the table. And then the price of oil goes back up again. And that, of course, is an inflationary fact of life. But it is good for earnings, of course, within that sector. But on the other hand, if we do see oil continue to languish, then the likes of BP, Shell, the big contributors to earnings growth here in the UK, then starts to diminish. How do we measure what's going on in that sector in 2023? And how do we take advantage as investors in that part of the market?
I think there are two drivers fighting off against each other at the moment. Driver one is that China is basically ditching its zero COVID policies. A bit late, but better late than never. And it's going to have an absolutely dreadful next couple of months. I mean, terrible loss of life that, wouldn't wish it on anybody. It's going to be, and that's going to be very deflationary for oil prices. And oil prices are already being impacted by worries about recession in the developed world, in the US and the UK. So that's weighing on oil prices. And I personally think you could see WTI go to below $70, probably Brent, well, certainly Brent below 80. So that's one driver. That's the kind of headwind. The tailwind is that China, we all know the shape of those curves with COVID, that the curve is going to hit quite rapidly within probably the Chinese New Year. So, January, February is going to be pretty torrid. And then basically they'll be over it. So by March, April, they'll be powering back into life. And you could pretty much guarantee the Chinese government, to maintain its kind of legitimacy claims, will be looking to really kickstart the economy, get things moving. So you'll probably see the credit taps turned on, and consumers encouraged to go out and spend. The classic Chinese industrial drivers, export drivers, will probably come back into play. They'll probably sort of softball all their real estate regulations and tech regulation stuff. So you're likely to see a quite resurgent to China come spring, early summer next year, and that will feed through to oil prices. And if, it's a big if, the American economy doesn't tip into a full-scale recession but slows down and maybe pauses for breath in the spring, then you could suddenly see another inflationary burst come through from that rising demand for energy from China and perhaps other countries as well, feeding through to the oil price. So I would, in answer to your question, I think it's quite possible you could see short-term oil prices drop even lower than they are at the moment. But you could equally see a situation where oil prices go back above 100, 120 bucks. I personally think they will go back above 120 bucks, because I think we'll as soon as we sort of think that we've plateaued, troughed the slowdown in economic growth, inflation will creep back into the system again. And that speaks to the worry that many people have had, which I don't know if it's going to happen, is that you have a stagflationary situation, which is stop, start, which is, economy slows down, inflation slows down, everybody takes their foot off the pedal, inflation seeps back into the system. That has got to be a scenario. And if that scenario does play out, and I don't know if it will, then I think the long-term impact on equities is not very good, because a stop-start scenario doesn't really help equities. You end up having a more volatile rating.
So let's talk about geographical areas if we can. You spoke about the direction of travel for energy helping maybe the FTSE 100. Do you see, we talked a little bit about America and Jerome Powell going into this interest rate raising circle system very fast and at a great speed. And are they going to come out quicker? Is the best place to be US stocks, do you think, or is Europe or emerging markets? What's your call for the markets overall in this context of the fact that it's going to be stop-start, but presumably there will be some pockets of profitability potentially?
Well, I think the energy sector has done very well for most investors until fairly recently, and in the scenario where oil prices go back above $100, it will continue to do well. So I personally have no intention of selling any of my existing US unconventional oil and gas stocks. The problem we all have is that, going back to my really initial observations, is that if the great deflator is corporate earnings are declining, then at the moment US equities are just overpriced fundamentally. I haven't looked this week, but last week the forwards PE ratio on the S&P 500 was still above 20, and that's not cheap. The long-term average on forward PE is about 17. So we're not at cheap levels yet. So I wouldn't be racing in on US equities. I think that value has had a good run. Value stocks have done reasonably well. But I think in this volatile market, it's quite difficult to play broad asset classes because there's so much variance so much volatility around the mean that it's really difficult just to say, oh, I think S&P 500 will do badly or do well. I think you sort of have to have a kind of rifle shot approach and just say what particular things you like within it. So the energy complex is one. I think that another theme that I've been talking a lot about on the newsletter I do, which is the Adventurous Investor newsletter, is greenflation. SocGen, French investment bank, have been making a big play on this, and I think they're spot on. I think that whatever happens, whatever you think will happen to the economy, there's going to be a secular long-term driver in favour of higher prices for anything to do with the green transition. So that, I think, favours lots of the industrial metals complex. Arguably, it favours the big mining companies, diversified mining companies. So I think there's a greenflation idea playing out here. And there's lots of other smaller drivers going on. So the biotech sector has had a dreadful couple of years. Yeah, so the biotech slump happened well before the main slump happened. Arguably, really kicked off towards the end of 2020, really, beginning of 21. Actually, even more late summer 20, after the kind of all the hype around COVID. And the biotech sector is possibly beginning to hit trough. It's beginning to hit low levels. So I think the way forward is maybe not just to say I think UK equity is a good value, US equity is a bad value, or vice versa. Is I think to take a more rifle shot approach and say which sectors do you want to be in this more volatile market. Yeah.
David, we've got to leave it there, but thank you so much indeed for joining us. It's a pleasure and a very prosperous 2023. That's the FT columnist, the Adventurous Investor, joining us there, David Stevenson.